Well, good morning to America. Good afternoon to Europe and London. My name is Ross Burland. I'm an analyst and editor for FXStreet. And I'm very excited about today's panel. We're going to be covering the US elections. It's definitely going to be a trendsetter, probably one of the most major events, certainly of my career and potentially of our lifetimes. It's been pretty crazy in the run-up. And today we've got an expert panel to navigate us through the event, leading into the event, the day of the event, and thereafter through into 2017. The idea of this event is to equip our audience with the tools and the insights necessary to, well, A, protect yourselves against potentially very volatile swings in the markets, and indeed to look for any opportunities where you can make some profits, because some of these moves could be quite substantial. We've just come through the Brexit EU referendum, and we saw what happened there, and this has the same kind of potential. So without any further ado, I would like to introduce our panel. And first off is Adam Button. Good morning, Adam. How are you doing?
Hello, good day. Doing great here today.
Okay, fantastic. Adam Button is the CEO of ForexLive. And over to Martin Armstrong. Good morning, Martin. How are you doing?
Oh, very good. How are you doing over there?
Very good. Thank you very much. Martin, you're an economist and founder of ArmstrongEconomics.com, the developer of the economic conference model based on business cycles and pi, of which was used to predict the crash of 1987 to the very day. So using your theory of the boom and bust cycles that occur every 3 or 141 days or 8.6 years, the number of pi multiplied by 1,000, I find this absolutely fascinating myself. And you've predicted like the Nikkei's collapse in 1989, Russia's financial collapse in 1998, and the Asian currency crisis or thereabouts. So let's get started. I want to start with a little bit of background to the event that's taking place on the 8th of November, the US elections. Now, there's a saying in America that anyone can become president. So boy, are they trying to prove that theory this time around. So this is a question for you, Martin. Now, you know, we've got limited time, so we don't want to focus too much on how we got here, but I mean, how have we got here? I mean, is this an indication of Western civilization in decline?
Oh, I think absolutely. I mean, if you look at it from a realistic standpoint, I mean, what they've done to Trump, digging up things he said 20 years ago, etc. Who in their right mind would want to run for president? I mean, it's, you know, forget what he said or whatever. If you're going to start doing this sort of thing, I mean, next we're going to hear about, oh, you cheated on your girlfriend in high school. You know, it's that we've gone too far. I mean, everybody knew JFK had women coming in and out of the White House, but nobody said anything. You know, there was a certain line they didn't cross, but now there's no lines anymore. So I also think that it's the Brit exit issue. I mean, we're in a global trend of really the government has just, socialism's kind of collapsing. All the promises that they've made for various different things just are not coming true. So we're seeing this not just in the United States. You saw it in Britain. When I was over there in Spain, I mean, Cantalona, everywhere you go, it's the same thing. It's people are just fed up with whoever's in government. And I don't think it's a particular individual. Mm-hmm. It's just Trump is the symptom of it, not necessarily the cause.
Mm-hmm. Okay, well, let's get back to the matter at hand. So these US elections have been dominating the markets. There are huge implications for them, depending on which candidate gets into the White House and the breakdown of parties occupying Congress, more importantly, perhaps. So based on their individual policies, right, markets have been taking a view on Trump's presidency or Clinton's presidency, and this is essentially where we need to start focusing today. While Clinton has been portrayed to us by the media as the favorite. It's clear that markets are preferring that outcome. It's more of the same, and so on. So, I mean, perhaps, Martin, we can look at that a bit further into the discussion. Now, a Trump win could be a real upset on a long-term basis, potentially far greater than the Brexit outcome globally. Now, we say that, but then we got to focus also on Clinton's foreign policies, which, to me, I mean, they frighten me. And also in respect, you know, into Syria and Russia and everything that could come of it. And she is much more of a globalist, whereas Trump's protectionist standpoint, I mean, Adam, we can look at this, could be something to consider in terms of the US dollar. So Trump being the anti-establishment vote, he would likely wipe the slate clean in terms of the existing US arrangements under the Democrats. He would, you know, look at things like trade policy, social spending, and immigration and geopolitics. So, Adam, coming over to you, would you mind giving us an insight, you know, to how we've got here, leading into the elections? What have you been focusing on in the markets? Have you seen anything particular that stands out to you? And then perhaps you could talk to us about, you know, what we could do on the event. I mean, would you be in it, or would you be standing on the sidelines, or take us through it?
Great. I have a little bit of a presentation that'll talk about election night itself and how to trade it and some of the things coming up. But in response to your question about the lead up, it's gotten a lot more interesting. I think markets were rather complacent until about Friday, and Trump started to get some momentum. The FBI reopened its investigation. The polls have swung slightly towards Trump in the past 3 or 4 days, and we're just starting to see the results of that now. So markets are jittery, and we've just seen it Monday. We've seen it today, or we've seen it yesterday, and you know, today markets are flattish. But there is this sense that Trump has momentum, and that is going to be the focus and leaks over the next few days. So it's a challenging time. You know, why don't I go ahead and share some of the stuff about election night itself, because I think that's the real trade. For now, I think almost the jitters have been smaller than expected. I'm not sure how to pop that up. I've got the strategy kind of presentation, just a bit on like the actual day itself and the breakdown. If you look back to the Brexit vote, I don't think traders were quite prepared for how the vote would come in. It wasn't just like a light switch flipped and suddenly we had the results. They stream in from different parts of the world or different parts of the country at different times. And the people who are ready for the different ridings coming in, and in the United States case, the different states will be the ones who are going to be ready. So, you know, if you look at the map, you know, we all know that it's very difficult for Trump to win. And on this map that I have here shows the states breakdown, and basically all the ones that are shown in brown are close, and Trump has to run the table on all of them virtually. There are a few other ways to get there, but that's basically the way he needs to get there. If we look at the polls lately, as I was mentioning, there's this momentum for polls. This is Real Clear Politics average polls. You see Trump up from just in a sharp line up from about 43 to 45. So that momentum is real. It's there, and we'll see more of it probably in the next day or so. And just here, quick look at what's priced in. You know, Clinton. Sorry, some of these are out of order. Clinton is priced in around 71% on the odds. Trump 70-30 is really where the betting markets are right now. The Senate is a little bit more skewed towards Democrat, and that's going to be important as well. And then Republicans are around 95% likely to hold the House, but are likely to lose some ground as well, unless this momentum we're seeing to Trump comes across the board there. So just on the election day itself, on November 8th, polls open around 6, 7 a.m. Eastern, depending on the state. You know, there was always that talk on election day of fraud. And that's something I wouldn't worry too much about. I mean, maybe a little more in this election, but it's always there almost everywhere. You know, these reports that kind of go quickly viral during that day. I wouldn't make too much about it. And I also wouldn't say, you know, the thinking is, traditional thinking is that it'll be quiet on election day. Markets can be a little bit more lively than you think. The rule of thumb is to fade it, but you try to, it is a tricky time to trade, and it's probably one that's best to sit out in that run up to the election. You talked about when it will be announced. The very first thing you can watch for is turnout. There are always anecdotal reports of high turnout. Every election, everywhere, and it turns out that's not always true. So be wary of that. High turnout in general would favor Clinton. She's going to be the person that's going to have a more difficult time getting her supporters to come out. There are trust issues that have arisen. No one really loves Hillary Clinton that much. So high turnout favors her. Also watch for splits. America breaks everything down by race. So Hispanic voters, Black voters, definitely more likely to vote Democrat. So if you see high turnout there, especially Hispanics, it makes Florida much more likely to go for Clinton. And then that makes it virtually impossible for Trump to win. Weather can skew it as well. We may have seen that in the Brexit vote. It's tough because America's a very big state to break down, and you have different weather in different places, but you can try to find a bit of a skew there if there's some big weather event. But in general, you want to wait for the polls to close. The first one to close is 7 Eastern. That's midnight GMT, midnight, midnight in London as well. And remember, we're changing clocks in North America this weekend, so double check all your clocks and timelines. Florida 7, that's the first indication. That, to me, will be the biggest intraday move. The exit polls we get from that, the first indications we get from Florida is going to be the single biggest 200, 300, 400 pip move potentially on the election and how that swung. New Hampshire closes at 7 as well. North Carolina and Ohio. So Florida, North Carolina, and Ohio, if Clinton gets one of those, it's all over in my mind. They'll close at 7:30, 30 minutes later. You'll see networks wait a long time to close it, but markets will move much sooner. So if she can get one of those, it's all over. And also note that the final polls, if Trump is in it, though, if he wins those, Nevada will be the really last tough state for him to win that he needs to win. That's at 10 Eastern. So that's really the span of time. And as those polls come in, they don't come in right away at 7 or at 10. And then at 11, you have like California and Hawaii and Oregon, but those are definitely going Democrat. So we'll know by then, but that oftentimes the networks might wait till they get some results from that, but that's a mistake. Markets will move sooner. An important thing to note is that states are highly correlated. So if you see Trump do well in Florida, it probably means he'll do well in Ohio. There isn't this big skew between states. So if you see it in New Hampshire or Florida, it likely means he's doing well right across the country, and that's why markets will move quick. So don't wait for networks to call it. You have to be quicker than network. By the time networks call it, there's almost like a sell the fact sort of trade. And we saw it on Brexit. There's this denial that will go around for a while, and then it settles in, and you have a trade almost where you can fade the initial move when it gets called. There'll be maybe one final spike once it gets called, and you can fade that and then back into the trend. For Trump, again, it's very difficult to win. He'll need one of Michigan, Pennsylvania, Colorado, Minnesota, or Wisconsin, and those are all very, very tough for him to win. And that's why markets are giving it still a low probability, but I think those jitters are just picking up. There's the map again. We'll race through just a few quick trades. If Trump wins, I mean, we talked about this before, high risk aversion. And I think what we've seen in markets on Monday or Tuesday are those jitters. It's yen strength, Swiss franc strength, and even euro strength are the three trades to watch, all against the US dollar and everything else. Stocks in big trouble if Trump wins. We're talking about for 2 weeks afterwards. Mexican dollar, as we know, very vulnerable. CAD, I think, is more vulnerable than markets expect. Bank of Canada will cut rates. NAFTA will be up in the air. Commodities, I think, will suffer. There will be a lot of talk about gold longs on uncertainty, but gold probably doesn't perform as well as people think in that sort of uncertainty. Oil shorts are probably a better trade in commodities. Clinton wins, relief rally. I think dollar yen is the spot to spot it in the FX market. It should be strong. Commodity currency against yen, I mean, like Mexican peso yen, probably the ideal trade. That's an expensive trade to be in. And the other thing to watch on election night is how close it is. It's not enough for Clinton to win if she wins very narrowly, and the results are unclear. Half of Americans polled are worried about violence on election night. So there's a real fear there. If that doesn't happen, even if it's close, I think those fears are far overstated, but that fear is real, and that fear trickles into the market to some extent. But a clear Clinton win is good news for risk trades. It just means, like you said, Ross, it's the status quo. I know how to trade the status quo. You know how to trade the status quo. Trump, we're not trading the status quo anymore, and that makes people go to the sidelines at first. And then just a final few thoughts on between then and now, because this is far from over. Even we'll be 5 days from the election. There's leaks every day from the Podesta emails. They're out. FBI investigation ongoing, and even rumors are moving the market. Remember the 5th of November, hackers, anarchists sort of love that day, the V for Vendetta and that Parliament bombing in the UK or plot. That's a huge day for leaks and bombshells. That's coming up on Saturday, so keep an eye on the weekend news. And I think everything else now falls to the wayside. I mean, obviously something like the Bank of England is important for pound, but more broadly, I think we saw it on the Fed decision. The Fed decision was what, 20 pips yesterday? Same as non-farm payrolls. I'd almost fade any move in any direction on anything that isn't election news. And finally, it's also important to know that 50 million Americans vote before election day. So even if something hits at the last minute, it might be too late, especially Florida votes heavy early. And that's roughly 1/5 of the public will have already voted. So that's it. The aftermath. Look for, in general, I think they'll be kicking and streaming in stocks either way. You always have half of the country disappointed, or roughly half. You saw it after Obama was reelected. Maybe see 2 weeks, maybe a month, probably through the end of November, because they're Fed jitters as well. If Clinton wins even, I think stocks will still be vulnerable. Definitely if Trump wins. But I think the trade later is to buy the dollar in December, dollar yen, and risk trades on the idea that there will be high deficit spending no matter what. Sorry, that's supposed to say 2017, high deficit spending in 2017. So that's my quick view on election night.
Fantastic. Now, it's very insightful. Thank you, Adam. Now, you mentioned gold there as a safe play. Not so much a safe play, and I was looking into silver, right? So you got Mexico as the biggest producer of silver. So imagine a Trump victory and what's going to happen there. You're going to be pulling out of those corporations, those mining companies, pure silver in Mexico, and flooding elsewhere. You're looking for silver opportunities elsewhere in the world. I think there's huge potential in that market as well. Not as a safe haven play, but that was just something off the cuff there a little bit. Also, in the run up to you mentioned there maybe just standing back on the lead into election day. Now, you might have some of our audience there a little bit more sophisticated with a portfolio that's diversified, and obviously this is something for our audience to explore and speak to their brokers about. But there are other opportunities to protect yourself with the use of derivatives and options and so forth. But thank you very much, Adam. That was excellent. Martin, we want to look at the Fed. Do you have any insights there in respect to be it a Clinton victory or a Trump victory, the effect that will have on the Fed? Now, obviously, Trump's come out and said that he would, he doesn't particularly dislike Yellen. He's a low interest rate guy, he's saying, but he has indicated that he would probably remove Yellen. So do you have any ideas of what that might pertain moving down into 2017 and in terms of their interest rate hiking policy?
Well, I don't think it would really have any impact because a president can't remove the head of the Federal Reserve. She has to finish out her term. So that's one of the caveats there, that they can't supposedly politically switch people back and forth. But make no mistake about it, the Fed is in a very difficult position. It has lost domestic policy objectives to international. You have if they raise rates, they're worried about emerging markets going bankrupt because they borrowed all in dollars. They can't pay. You have the IMF lobbying them, please don't raise rates. when you have Japan and Europe going in the opposite direction. But the crisis that you're creating here is the pension funds are all going belly up. They need higher interest rates. And this is how it kind of reminds me really of the S&L crisis, in the sense you create a law that say S&Ls must invest primarily in real estate. Then you change the amortization tables on real estate, and then you create a one-way market and everybody wants to sell. And then what do? You then blame the people that run the S&L for being in fraud or something. I mean, Congress never looks at these decisions actually on a coordinated basis. And lowering interest rates is very nice, but then you have with these pension funds, you have many countries are by law have to have 80% government bonds. I mean, Social Security in the United States is 100%. But so if you have to be in government bonds and you're paying virtually nothing when you need 8%, you're looking at many states are going, belly up. And I have friends on the Hill, and I can tell you Texas is the one that started lobbying. They've been joined by California and New York, and they're basically lobbying Congress that they should take over all private pension funds and then therefore put it in a bigger pot so that they can cover up their losses on the public funds. So we're really in quite a mess. And Yellen keeps saying that we have to normalize interest rates. That's the code word for saying if we don't get interest rates up, we got another crisis coming. And that's on the pension side. So it's like we're damned if we do, we're damned if we don't. It's really a mess. So we're talking I don't see either candidate changing the policy of the Fed. Right. And the same thing with all the talk about, trade deals, et cetera. That still has to be voted on by Congress. I mean, Trump can stand up there and say whatever he likes with NAFTA, whatever. But you're talking about, taking years to do it. And assuming it would go through. So, I mean, the biggest thing I think with Trump that would be positive, it would be lowering the corporate tax rate down to 15%. You got about $3 trillion sitting offshore. That would definitely bring it back. I mean, we have mostly corporate clients. And why would they bring it back if they're going to pay 40%? It's simple as that. So he's correct on that side. But, so it really depends tremendously. I mean, Clinton is the status quo, supposedly, but she's more prone to raise taxes. And the higher you do raise the taxes, the lower the economic growth. I mean, it's a straight up correlation. So it's the future is not necessarily as clear as many people might think. And I do think as we go into this election, I can tell you I'm in Florida, and you go just driving on the streets, there's people with Trump signs. I never have seen anybody with a Hillary sign yet. This is definitely Trump country, and it's quite interesting. But I think there's it's going to be a little bit more like Brit exit, I think, because you have all the media against Trump, you have the polls against Trump, but I wouldn't necessarily count him out so easily right now.
No, I wouldn't either. Especially with the recent change of events, and you think all of those that were robbed of their Bernie Sanders vote, and now they have more of a reason, to go out there and vote Trump. And even those that are too embarrassed in the polls, to say what they're going to do on voting day. I'm sure he's got tens of thousands there that are sort of sitting on the bench waiting for, kickoff on the day. So, no, I'm not ruling him out either. Absolutely not.
Yeah, I think the forget the polls. If you look at how many people are donating to who, you see Trump has about 3 million more individuals donating to him. It's all the small money, whereas Clinton gets all the big money from the PACs, from Wall Street, etc. But they don't vote. So, Clinton Bush actually does outnumber. I mean, Trump actually does outnumber her on an individual contribution. And of course, when he has rallies, there's tens of thousands of people there. You don't get that at the Hillary side. And it's interesting that Bush Sr. came out and said he was going to vote for Hillary. So, I mean, that's kind of like, to me, it seems like almost like Obama going to London and saying you're going to be at the back of the queue. There's just something seriously wrong going on here. And everybody I talk to in Washington say there's really is a battle behind the curtain going on from both sides. It's just really quite amazing.
So either way, it's a binary event, right? So Adam, what are your calls on a Trump victory?
Yeah, I think there's that dawning of uncertainty that hits when Trump, you get a lump in your throat and think, okay, like this actually happened. You know, even I think Trump supporters, for all their enthusiasm, don't truly believe it's going to happen. I'm not even sure Donald Trump truly believes it's going to happen. I think he's suddenly much more hopeful. But the dawning of uncertainty is heavy for markets and risk trades. You always have the option in markets to move to the sidelines or to move into bonds. And I think that has to be the knee jerk. Europeans, you know, you see Americans, sure, there might be some enthusiasm there, but you look to Europe, it would just be disgust. And other parts of the world as well, they'll pull their money out of the United States. And that's why you'll see euro gains. Obviously, Swiss franc, the yen, like I talked about on the pure safe haven trades. The Fed won't hike in December as all that volatility hits. So you have plenty of uncertainty that is for sure the trade on a Trump win.
So in respect to a flight to bonds, Martin, are we not already in a bubble?
Oh, it's unquestionable. It's an unbelievable bubble in bonds, but you have the Fed buying, you know, you have every central banks in the world buying. Like Martin said, pensions have to buy as well. So the only one buying bonds, people who have to buy bonds or for some kind of short-term risk aversion trade. But you know, 2% on bonds, it's terrible. It can last.
Okay, we got some questions from the audience coming through, and we're sort of covering a little bit of old ground here. I mean, how big of a shock would a Trump win be for the markets? Bigger than Brexit referendum? What do you think, guys? Definitely. In my opinion, yes.
Our computer is not showing that. It is showing higher volatility, but it looks like about a 3-day reaction after Tuesday. Mm-hmm. So it doesn't look like a big trend. I think the big trend turning point looks like it's going to be January.
Okay, so, but I mean, longer term, in terms of global market.
You have to look at it this way. If Hillary gets in, we're probably going to spend 2 years in investigations, impeachment proceedings. Will anything get done? I mean, it's just going to be one scandal after the other. So I'm not necessarily so confident that a Hillary victory will be, you know, a clear path to someplace other than total chaos. So it's hard to say, but and I don't think that Trump will be able to get a lot of the things that he wants through Congress. I mean, you're just going to see a lot of infighting and backbiting there too.
Mm-hmm. Okay, do you think he'll win, Martin?
Pardon me?
Do you think Trump will win?
Our computers actually suggesting that he should win. It does give him a slight victory, and our computer, which doesn't look at the polls, it basically derives this from capital flows and markets. It came out, it was correct on Brit exit. I mean, I thought it was wrong. Personally, I mean, I didn't think they were going to win, but it won. And it's saying that that Trump should win. That's not my personal perspective or view or whatever, but that's what it says. So sometimes it's better than I am.
So let's say Trump is in, right? He's going to go for, he's going to want a weaker dollar, right? He's going to go for the Bank of Japan. He's going to go at China. But do you think, I mean, in the background of these G20 meetings, Martin, I mean, are they colluding? Are they working together, these central banks, and taking turns and, you know, coordinating it between themselves? I mean, could Trump pull it off?
Well, yes. I mean, I think you have gotten to the point of these negative interest rates, et cetera, from the ECB and from Japan have really just created this bond bubble, which is insane. And you have to realize, yes, the central banks have been buying this stuff. Could they ever sell it? Nobody will buy it from them. So they're kind of stuck in this position. They have to wait for whatever debt that they bought to mature. That's it. That's their only way out. There's no other exit. If they suddenly stood up and said, oh, okay, fine, we're reversing our policies, and by the way, we're going to sell everything we bought, watch out for bonds. You're probably talking about a 50% collapse. And the biggest distinction is the amount of money in the bond markets versus equities. Equities are dwarfed. I mean, what really made the Great Depression was the fact that you had the sovereign debt crisis in 31. I mean, most of Europe went into default. Britain even went into a moratorium. China defaulted. South America defaulted for the fourth time in a row. So you just had a complete wholesale wiping out of the bond markets. And that was it. So you destroyed capital formation. Equity, yeah, they go down to 10 cents on the dollar or whatever, and then they rally back. You're not wiping it out per se. But bonds, it's either when you get into the government bonds, they never pay off. They just always default. So, I mean, I've been on Capitol Hill and I've asked, I said, why do you guys borrow if you do not intend to ever pay anything back? And nobody can answer the question. So, that's it. So
in terms of the US dollar, longer term, and if we look at, say, the Bank of Japan, we look at dollar yen, Adam, we're at these levels now in dollar yen, right? We've come down from the 125 area over a relatively short period of time. We've been sort of stagnant now between 100 and 104. You're advocating there that yen is likely to move up in risk aversion. So it's definitely on a Trump win. But, I mean, how far do you think the Bank of Japan could allow the yen to, how far could it strengthen in terms of the Bank of Japan?
It's the same problem with the Swiss franc, and we're already close to the limit of where they like to be. That's the conundrum if we get risk aversion. But I think in the cases where there's a genuine reason for risk aversion, they tend to let it go on a little bit longer leash. I think we're down around 95 in dollar yen is where you might start to get worried. But I think you could even take it down to 90, depending on the magnitude of the event. And I mean, we're all about trading sort of in real time. And I think you gain knowledge as time goes on after the election. And that the big thing we'll be watching is the concession speech from Trump, if he's making it, or the victory speech, if he were to win it. If it's a very clear, professional concession speech, calm and urging calm, that is very good news moving forward. If it's the opposite, obviously you have some risk aversion. On the flip side, if he's winning and he's not talking about building a wall or trade or talking about following through, but rather talking about working together with Democrats, and he's going to say some of the Make America Great Again stuff. But if he keeps it to a minimum and tries to sound presidential, then I think you have a little bit less of the worry out there. But I think almost in any case, you're getting into weeks of uncertainty in a Trump win.
Okay. And sticking with the dollar, I mean, I've been battling against an uptrend in the dollar for all of this year, basically on the Fed. So, Adam, you called it. There was a panel that we did before the end of last year, if you remember, and you said very rightly, you said that you don't think the Fed are going to hike. They haven't done. They've been, kicking this can down the road now. They've been trying to portray to markets that they will be, right? So they've been keeping us on the edge of the seat. I don't know about you, but I've given up listening to what they say in their statements. I mean, look at yesterday's, for instance. I mean, they changed some of the language, trying to mix it up a bit to make us feel that December's on the cards. Do you think December's on the cards?
Yeah, I think it is. I mean, if the election runs smoothly as expected, they're very eager to hike by December Fed meeting. There's time for a little bit of calm. I think they can probably ride out a 5 or 7% dip in stocks. They always get nervous on the stock market, but this is probably it. And then next year looks a lot like this year. They're talking about 2 hikes next year, and it probably just won't happen. The flip side is, and I think you really do need to watch Congress if there is some sense of working together. Because remember that the Congress hates Trump, the Republican Congress hates Trump as much as the Democrats do. They're happy to get rid of him. They're happy to isolate some of the populist wing of their party, at least the establishment, if they can hang on. So they might be willing to work with Hillary and open up the spending spigots. And if America can run some large deficits next year, the US dollar can do very well. The stock market can do very well. So that is the angle I'd be watching on that kind of trade. And I think it's likely, I think elsewhere in the world, you're seeing heavy deficit spending. And I think that the fears about debt are diminished. And I think central banks have monetized debt essentially. They won't let bonds run off. They'll just reinvest forever, especially in places like Japan. And the spend, and it will just hurt the currency, but nobody wants a strong currency anyway. So I think we're entering an age of reckless government spending, and that is very good for stock markets.
So Martin, are you on the same accord, or are you like me? I mean, I don't think that the US economy warrants an interest rate hike. I don't. I mean, eventually interest rates have got to go up. But, we're running on GDP. If you look at the deflator and you combine that into the GDP, I mean, on average for this year, about 1.5% growth, right? So moving into 2017, I think there are so many problematic things to come about, right? There are so many risks. I don't know how the US economy can improve overnight. I certainly don't think they're going to improve from yesterday's vote to December's. What are you thinking for 2017, Martin? I mean, there's a lot of speculation out there that we're heading to absolute disaster throughout the world. We've got, potential war. We're on the brink of wars, looking at Syria and so forth. People are talking about, the dollar's going to crumble. Could the euro be the next, the petro euro and so on? Have you got any insights for us on that for next year? I mean, are we heading for QE4 in America?
I think as far as the GDP is concerned, this is the weakest recovery of any time. So it's you have participation in stock markets are still at really about the liquidity is about 50% of 2007 levels. You have the Gallup poll came out and showed only 55% of Americans are invested in equities, where last year was the historic low at 54 compared to 65 in 07. So we don't really have a tremendous retail participation in the stock market. It's mostly institutional money that's been flowing in, just trying to park. And that's really what's going on, because a lot of it's been from Europe because they're afraid of the banks, etc. But when we look forward going in here, what would actually cause the Fed to start raising rates? It's probably the same scenario that you had going into 1929, that there was a G4 in 1927. They lowered rates in the US, trying to deflect money back to Europe because they were in trouble, and it backfired. And once that happened, the people said, gee, I guess Europe really is in trouble, and the money started flowing this way. So if you do have war, etc., I mean, we did studies on that. It's very interesting. That's what made the United States dollar what it is. I mean, in 1896, the U.S. was virtually bankrupt. That's when J.P. Morgan had to make the $100 million, gold loan, bail out the Treasury. So from 1896, then you had World War I and World War II. By the end of World War II, U.S. ended up with 76% of the world gold reserves. So that's why the dollar became the currency. Money goes this way when the war is over there. All right. The only time money fled the United States with war was the Cuban Missile Crisis, and also the Civil War, of course. But so money always tries to move away from wherever the event is. So if we do have a war in Syria and Ukraine, etc., and it puts Europe at risk, the money's going to come this way. All right. If that plays out the same way as it did in the 20s, then what did the Fed do then? It will see the stock market going up because basically that's where the money goes. And then they will see that as inflation. They'll raise interest rates to stop the inflation, even though GDP is not there. So the only way I see getting GDP up is basically tax cuts. That's it. That would bring the money back. But other than that, you listen to Hillary, she's, Social Security goes negative next year, so does Medicare. And she's already come out and said she's going to make the so-called rich pay more. Well, the rich are basically the small businesses, which employ 70% of the people. So, that's household income of $250. If she's going to make them pay a lot more into Social Security, which is bust anyhow, and that wouldn't solve it, you're only going to raise taxes, which is going to basically increase unemployment and lower GDP even more. So, I don't see that as an outcome. So I think it really doesn't have a lot to do with GDP. I think it has to do with perception of what's going to happen in the world, wars and things of this nature. That's what really moves capital. They just try to get out. That's why interest rates went negative. If you look at the PE ratio of S&P, when was the historic high? It was 2009, went to 120. Even the dot-com bubble was 50. All right. So 23-1 is not excessive. All right. Why did it go to 120? It's the same reason interest rates went to negative, or like on the bonds. People were like saying, I just want to put my money someplace. I don't care what I make. Do I get it back? So when you're just in a parking mode, then PE ratios mean absolutely nothing. You're going to buy the blue chip, so the company's going to be there. So can I cash out back and forth? Okay. That's why they were buying bonds at negative rates, 10-year rates. That's crazy. Mm-hmm. But it's like, okay, at least I know where my money is.
And I suppose that argument where, if let's for instance say the Fed, they've been bluffing all this time, even if they do hike rates and then they only to decrease rates again, move into QE4, the dollar starts to tank, gold prices start to go up. Have you got a view of how high gold prices could go up? Or, I think you've basically touched on it there, the pension funds, they need a dividend, so they're not going to buy into gold themselves. So the gold market is only really restricted to the retail market, and you've got some claims out there of $10,000 an ounce. What's your feelings on gold, Martin?
Now, we do show that it could go up to about 5,000, going out, maybe, into like 2024 or something like that. But you have to realize when you say that number, what does that mean? And I can tell you, I've been in discussions. There are people in Washington right now who feel the dollar being the reserve currency is negative because you lose domestic policy objective because of international. So you had everybody borrowing in dollars. So the IMF lobbies the Fed, oh, please don't raise interest rates. You're going to hurt the rest of us outside. So how can the Fed manage the economy if it has to worry about what it does to somebody else? So there is a lot of talk going around in Washington. I've been in a few of these meetings, and it's basically talk about how do we make the dollar not the reserve currency to get back your freedom. So I really do feel you're probably looking at a monetary reassessment. The IMF is pushing to make the SDR the new reserve currency. I wouldn't agree with that because the IMF, to me, is a very corrupt organization. But we're probably looking at something like that, because certainly China and Russia also are against the dollar being the reserve currency. So I don't think you're going to see something like that before 2018, but I do think you're certainly going to see it no later than 2020. We're going to have some sort of a new basket international currency for trade globally. I think that's where we're coming. So the question becomes, okay, where do you see gold? I mean, gold, it depends. All right, what is the dollar? Is the dollar still the same dollar as it is today, or are we talking about a completely different dollar from purchasing power perspective? So just looking at it in nominal terms, yes, it can go up to 5,000, but at the same time, the Dow can go up to about 40,000. So it depends what you're buying with that dollar at that point in time, and we're looking at more of a like 10 years out, not necessarily next week.
Okay, and then you touched there on Russia and China. We got a question coming in from the audience that 5,000 troops have been sent to China to back Russia and NATO moving tanks to the Russian border. Is your computer reflecting the same moves of the current?
Yes, our computer basically said that the war cycle and civil unrest, etc., bottomed out in 2014, and it's been in an uptrend since. So we shouldn't probably see a peak in that until about 2018, 2019. Does it mean world war? It's hard to say, but certainly we're seeing the civil unrest. Not just the threats of in the United States if Trump wins or loses or whatever, but we're seeing that everywhere. I mean, in Europe, you've got to have all these separatist movements. When I was there in Spain, you guys asked me, gee, what's the computer say in Cantalona? I said, you're going to vote to leave. Everybody would say, gee, that's kind of against the polls. The computer was right there too. So it's been much better than I am personally, from my opinion perspective. I think it's just looking at the economic flows, and that's it. I mean, the same thing when Russia collapsed, we got the long-term capital management deal. I mean, the computer basically said Russia would collapse and gave it about 30 days. And the FT put that forecast on the front page over there. But what was it based on? We saw $100 million or $100 billion in capital inflows to Russia, but $150 billion coming out. So it looks largely just really the capital flow movements. And that's what your question about war and could the dollar change. If you get war over there and it scares capital, it's going to move this way. If Russia were to invade the United States, then it's going to leave here and it's going to go someplace else. So it's a very black and white type of thing in that how capital moves on those types of events. So those are the wild cards that we have to see going forward.
Okay, guys, right. So I'd like to start to wrap it up. We're heading towards the end of our session. And Adam, I'm just going to put you on the spot, if you don't mind. Have you got the perfect trade for yourself for 2017? Have you got any ideas? Anything out of the box? Anything you'd like to tell us? Anything up your sleeve?
I think you still have plenty of time before 2017, but I think that CAD shorts are a good trade. I don't think, like, the economic recovery is weak. Disinflation is a problem. The Bank of Canada is likely to cut rates much more than the market thinks. It's priced around 20% for Q1. I think it's coming in Q1. Housing troubles in the West Coast are for real. And I think oil is vulnerable on oversupply as well. If you add in some risk aversion or economic weakness due to political instability, it's an even better trade. But we'll know so much more after November 8th in terms of what the trade is for next year. But that's one spot I'm looking at, something like 140, 145 easily in dollar CAD.
Okay, fantastic. Well, guys, thank you very much. I think it's been very, very insightful. I've been jotting down a few things in my head there. So thank you, Adam. Thank you very much, Martin. And we hope to see you again soon.
Well, thank you for inviting me.
Yeah, I mean,
Cheers,
I'm looking
guys.
forward to the election. I didn't even get to put my "Make America Great" hat on here again. Not that, just a joke hat. I got that Trump. I mean, as a trader, to be honest, you like volatility, and Trump is the definition of volatility in the week ahead.
Yeah.
Not that, you know, I don't really care personally one way or another. I don't live in the United States. But as a trader, you do like that volatility in those events. I mean, Brexit was a lot of fun if you weren't in Britain, and obviously I feel for the people who feel the impacts. But really, as a trader, my heart's not in it. It's just for the head and the click of the mouse, and it will be interesting to see the headlines as they come.
All right. Well, we better get back to the screens because we might have missed something already. All right, guys. Thank you very much. Take care.
All right. Thank you.
Thanks.
Bye-bye.